Hello, everyone. Today on the Final Bar, we're joined by Julius de Kempenaer from RRG Research, coming to us from the Netherlands, sharing his thoughts on sector rotation, some of the big leadership names that have been driving things up until now. We've got a huge earnings week with things like Facebook, Apple, Microsoft, so many of these names coming out. And the question on a day like this, strong earnings from Microsoft, the market's selling off, the S&P closing down almost 3%, with a lot of give back in some of the key names that have gotten us here. What's next for stocks? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of StockCharts, using the lenses of technical analysis, behavioral finance, investor psychology, sentiment, price, breadth, whatever else we can do to try to make sense of things. It is uncertain times. We've been experiencing these for a while now, but certainly, I feel like there's no end to a growing list of new experiences we're all having as investors. The influx of a number of inexperienced investors, sort of the Robin Hood effect, the explosion in stocks like AMC and GameStop and others. It's a fascinating time to be looking at the markets. As always, I would tell you there is so much value, having been through a number of uncertain times and a number of sort of new experiences, the tech bubble, the housing bubble, the financial crisis, all of these different things. I will tell you that the discipline of trend following, the discipline of charting, and of focusing on investor sentiment through the information that is embedded in price action still is more important now than ever. Now we have some great guests coming through the Final Bar to help us try to make sense of things. Excited to talk to Julius de Kempenaer here a little later in today's show. Coming up next week on Tuesday, we have Tony Zhang. Tony's a chief strategist at Options Play. On Wednesday, we have Louis Yanis. He's the founder of WealthNet Investments based in Denver. And then on Thursday, we have Leslie Juflas. She's the founder of Trading Live Online and is a frequent guest host on Your Daily Five on StockCharts TV. So I'm excited to get their takes on what all is happening. And again, we're in the meat of earnings season right now as we transition to our market recap. We're in the meat of earnings season. We had the Fed meeting today, which I would tell you on average, all else being equal, that's where your attention should be. Comments from the Fed and the market's reaction to that, big earnings releases, and whether mega cap stocks are able to outperform their estimates, surprise to the upside, show continued earnings growth and the potential for further earnings growth through this year and beyond. But I tell you, those are just some of the many things that we're dealing with in terms of potential headwinds and tailwinds. We have this huge unknown, this new phenomenon of stocks like GameStop going up 100+% at a clip day to day as we have epic short squeezes and gamma squeezes happening. We talked a little bit on yesterday's show about that. We have the coronavirus, still so much unknown about how we recover from that, if and when rollouts continue in terms of vaccines, how economies have to shut down, reopen. And again, all of those things, everything I just mentioned in terms of potential headwinds and tailwinds, I think it's important as a well-informed investor to understand as much as you can and to make, your best estimates and your quantify and qualify your expectations of how those things might impact the markets. But if you do nothing else, focus on the trends, focus on the charts. That's the most important message to capture. And having said that, let's look at some of them together. The S&P certainly showing some weakness today, down over 2.5%. It was really everything was negative. It started off, gapping lower. The Fed meeting this afternoon. We had comments from Jerome Powell, and the market really accelerated to the downside going into the close. A bit of a bounce in the last 30 minutes, but overall, certainly a lot of weakness. It was across the board. Interesting notes to pay attention to. The small cap index actually finished up okay, down about 1/3%. So, certainly it was the mega cap stocks leading the way lower, mid caps down as well. Small caps were sort of the outlier here in terms of doing okay. The VIX has really spiked to the upside, now around 3250. This is up from the low 20s not too long ago. The dollar is strengthening. Interesting, my guest yesterday, Bruce Powers, was talking about the rotation, a potential rotation from weaker dollar to stronger dollar. So far, his comments have played out pretty well, with the UUP up pretty good, about 0.2%. Bond prices increasing to the upside. We've talked about that potential rotation of weaker stocks and stronger bonds. 10-year yields back down nearing that 1% level from above now. Looking at the commodity side here very quick, gold actually down today, really gapped down in the morning, came up and then sort of gave away any of those potential gains through the course of the day, down to around 172.60 on the GLD. Most commodities down except for oil and natural gas, which are up just a token amount. Cryptocurrencies continue to distribute. And when you look at the chart of Bitcoin, obviously coming down from 42,000 to 31,000 is a significant move. This is sort of the average volatility that you have in some of these cryptocurrencies, but you can see a lot of red on these charts as we continue to see rotation out of those assets. So on a day when it feels like everything's down, it's always important for me to look at what actually worked. So a couple commodity ETFs, the USO and the UNG, these sort of the energy related commodity ETFs did okay. Bond prices up, the dollar stronger, and essentially everything else down on the day. That's the general sense of how I would describe what happened. Let's look at some of the charts here to finish off our market recap and see what's happened. So we've talked about this trend line a number of times, and I remember saying something like this yesterday. The trend is fine as long as we remain above this trend line. And while I don't treat it as a trading system, a break of that trend line for me would indicate a potential change of character and would cause me, when I dig a little deeper, to see what happens and if we're able to hold the most recent swing lows. What's happened 24 hours since we recorded those comments is that we've seen exactly that, right? We gapped down right to that line and closed lower around 3750 on the S&P. This is taking us right to that most recent swing low. So what I would be looking for Thursday, Friday of this week is, do we get that follow through? Anytime you get a breakout to the upside or a breakdown of support, it's all about the follow through. It's all about what comes next. And so for me, we're right at that point where either we hold this support and this is a buyable bounce around the 50-day before we continue the next leg higher, or this is the beginning of something much deeper. And I think the market's ability to hold a previous swing low is one of the first things that would tell you something might be, something is okay, or something might be a little more significant. So at this point, we have broken the trend line. That is the first indication of a potential change of character. I'd be looking for follow through tomorrow. On a day like tomorrow, we can easily have a bounce off of support, at which point 3750 becomes more and more significant, or we continue lower, at which point next show we will talk a lot about some further downside risk assessment. This green shaded area we've had on this chart for a while, and I still think it's very, very relevant. The 50-day moving average, not too far below where we're at. Those would be the next levels of support, around 3,600, 3,650. That would be the swing lows from mid-December. That would be the high from early September. That would be the next place I would be looking for some short-term support. We start breaking those levels, and we're going to talk about some deeper Fibonacci retracements and think about some long-term downside objectives. But overall, that's sort of the general sense of things. Just continuing on, looking at some sector rotation, everything down, as I mentioned. The biggest or the least down today, or the top performing sector on a relative basis, energy and real estate essentially tied for first place here at the top, followed by consumer staples. And consumer staples has a bunch of those names like Kroger and Albertsons and others that are sort of, I don't want to say artificially higher, but I probably will say artificially higher, driven more by some artificial demand, options trading and so forth, but certainly showing some internal strength. On the downside, these are some of the sectors that have gotten us to the all-time highs that the S&P has been at not too long ago. The XLC with stocks like Alphabet, consumer discretionary with stocks like Amazon, Home Depot, and others. Those are the two worst performing sectors, followed by healthcare as well. We talked about biotechs a bit on the show yesterday, and so interesting to see how that plays out. A little later in today's show, we're going to talk about scooter reports. We have a segment called It's All Relative. We'll focus on some of the top performers. We've had a bit of a shuffling here at the top 10 in the large cap space, and I just want to walk through some of those and show you some of the top charts. And again, in an environment like this, it's always interesting to see how the top performing names, the names that got us here, which ones are they struggling or are they continuing to hold up? That's one thing we'll try to tease out. I would also point out, we don't have a lot of time on this, but anytime the market has a big down day, which today certainly qualifies, I mean, it's one of the worst days we've seen in quite a while, down over 2%, but it's always worth noting which groups actually held up okay. So groups and sectors I would pay attention to, something like drug retailers, which are actually up 1.6% today, hotel and lodging REITs, telecom equipment, aluminum. These are all groups that actually did fine. Coal stocks, which is a pretty small group. It's more of a small mid-cap group here in the US. But, looking at some of those groups that actually did well on a down tape is actually kind of, can be kind of instructive. That can tell you where people may be rotating and where there might be some opportunities to get defensive and ride out some of the negativity that you see in the markets. Finally, I just want to briefly look at one of these charts here. When we're thinking about breadth, one of the charts that comes to mind in my normal routine of looking at breadth conditions, the cumulative advanced decline lines are really not too negative yet. They're still in an uptrend of higher highs and higher lows, similar to what you're seeing with the S&P. It's pulled back, that's absolutely right, but really hasn't gone too much below the most recent swing low. So still much more downside would have to happen for you to really think that things are getting bad. It just feels bad that we've had a big down day after so many up days. But this is one thing that has given me pause before today, which was the divergence of the percent of stocks above their 50-day and the S&P going to new highs. We have the index going to new highs. We have this breadth indicator. The percent of S&P stocks above their 50-day has actually been in a downtrend. It's been making lower highs, which shows you a lot of stocks, about 20% or so, have already started to break down through the 50-day moving average. And while the S&P has not yet done it, a lot of times what happens is you'll get some early breakdowns from other parts of the index, and then the S&P will finally catch up on its own. I recorded a video on this earlier. I was actually last night, we posted it on my own YouTube channel, Market Misbehavior. So if you want to know more about that, check that out, and you get some more details on that particular breadth divergence. We need to take a quick commercial break. Back with my guest, Julius de Kempenaer. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you on joining us for our show every weekday after the close as we debrief on these markets together using the power of technical analysis. As a reminder, we are a resource for you here as you go through your own analytical process, charts you're seeing on other platforms from research contributors, articles you're reading, whatever you want to dig into a little more and have us focus on. We're happy to take your questions. Shoot us an email. thefinalbar@stockcharts.com is our email. On Twitter, just tag us in a comment at FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'll do another mailbag segment on Friday's show, and we'd love to answer one of your questions on the air. I want to welcome on my guest back onto the show, Julius de Kempenaer from RRG Research. Julius, appreciate you joining us late in the evening for you in the Netherlands. Welcome back.
You're more than welcome, Dave. I'm glad to be here.
So,
interesting day.
It's fascinating and an interesting day among many interesting days, I feel like. And we've obviously, a lot of people are thinking about rotation. There's so many themes out there of stocks versus bonds, of growth versus value, of leadership and what we're seeing. We're starting with the weekly RRG, which is one of my favorite visualizations. Just understand sector rotation. Talk us through what you're seeing here.
Yeah, if we don't have a lot of time, but the area, a lot of people know the RRG by now, so it shows you the relative moves around the S&P 500, which is the center of the chart. And the area that I would like to focus on now is right next to your cursor, the little cluster inside the weakening quadrant. And there's three sectors there. There's technology, there is communication services, and there is consumer discretionary. And out of these three, you can see that discretionary and technology are actually making their way back up to the leading quadrant. And that's usually a good sign, because these were the sectors that have driven the market higher earlier in the year. Well, I have to say last year. And then they dropped back, went into weakening, had a little bit of a slow period, and they now started to curl back up. Communication services is the other way around. It actually coming from leading, it's moving into weakening, and it's heading towards lagging. So I'm going to forget about communication services for now, but I want to focus on technology and consumer discretionary, because I think that those two sectors have the potential to pick up their leading role again in the sector rotation story. And if you look at the technology bit, and we dive into the individual charts, there's two individual stocks in technology that are massively important. First one is Apple, of course, and that has just broken out to new highs. You see that horizontal resistance around the 140. We broke earlier in the week, and we're still holding up there. So I think that's a good thing. Now, the second big stock inside technology, of course, is Microsoft. So together, those two stocks are making up 45% of that whole sector. And what you see here is that Microsoft today is not doing too great, but you could see a big triangle formation building there. Yeah, exactly there. That's the upper boundary, and then you got the three lower, the three higher lows, I should say. And we seem to be breaking out of that triangle. Of course, we have to wait until tomorrow's close to be sure. But if that holds up there, we've got two of the most important stocks inside technology that are breaking to new highs. And they could very well drive the technology sector back into the leading quadrant. And that's obviously, I think, a very bullish thing. And if we still have a little bit of time, we can look at the two most important stocks inside discretionary. And that obviously is Amazon. And what we see there is a bad day today, but there you see also one of these, triangle-like formations unfolding. Amazon needs to break higher. It's not doing it like Microsoft did it, but in essence, this should be a bullish, continuation formation. If that happens, Amazon obviously a big driver for discretionary, and the same, somewhat similar, you'll see in Tesla, where we had this big run up. Today is not exactly what I wanted. If we can make that a daily chart quickly, then that little pennant stands out a little bit better. Yeah, there you go. So you have that. We had that massive run up, and then you have that little pennant. We broke 2 days ago. I was actually looking, to be honest, for a further rally. So today is kind of confusing it a little bit. So we need to keep an eye on what's coming. But Tesla, it's definitely not a bad chart. Let's say it like that. So we've got Amazon and Tesla inside discretionary doing really well, and we've got Microsoft and Apple inside technology doing really well. Both sectors pushing towards the leading quadrant. So on a day like this, I like to step back and move to my weekly charts and take a little bit longer term perspective. And really, it doesn't look all that bad at this point in time.
It's such a great take, and I should make it clear. We didn't mention earlier on. These are all weekly charts for the most part we were looking at, and when you take a look at the long-term chart of Microsoft, all the volatility, all the movement we've had is literally just the tiniest little farthest right edge after this incredible run. I mean, just a beautiful secular bull run in these names, and a lot of the FANG stocks have been sort of chopping around, but just starting to emerge to the upside. So if you're, I would be curious what you think. Just we have about 30 seconds left. How do you think of something like Microsoft, Apple, names that have gotten us here that are starting to emerge versus things like financials and energy that I think a lot of people got sucked into in the fourth quarter? If you're looking forward from here, which way are you leaning?
I think that like financials had a pretty good run, but they're now way up into the leading quadrant and starting to roll over. So I think the potential right now is more in the sectors that we just discussed. So materials, industrials, also financials, they are now sort of rolling over. So they had their run for the time being, while discretionary and technology actually are coming back, and they look ready to make their second, third leg in the existing uptrend. So for now, I think my preference would be for discretionary and technology, because the others, they're sort of cooling off from the runs that they had.
As you know, Julius, I've used RRG for a number of years, and I've always found it to be helpful to think about emerging leadership. And I think you hit on a great point. Things like financials and others sort of had a bit of their run, and now we're looking for what's emerging next. Julius de Kempenaer, always a pleasure to have you on. Hope you and others stay safe around you, and we'll talk to you again soon, all right?
Thanks, Dave.
That's Julius de Kempenaer. Julius is the founder of RRG Research. He hosts Sector Spotlight on StockCharts TV. I'd encourage you to check out his shows. He does a great job of talking in a lot more depth about the methodology. We were able to tease a little bit on the show. We're able to use as much as we can, but I'd encourage you to check out Julius's work and on social media as well. Our next segment is called It's All Relative. This is where we focus really on relative winners and relative losers. And there's a whole relative strength theme to today. The reason why I wanted to do that today is just when you look at a market that's down, I mean, the question always is, where do you go? And so, for me, when it feels like everything's up or it feels like everything's down, it's an opportunity to differentiate stocks by looking at relative performance, looking at what's working on a relative basis and really thinking about the relative winners. Now, we have different ways to define, relative strength. And one of the ways with RRG that Julius was just using, putting a group of ETF stocks onto a rotation and just seeing what's working. We also have the Scooter rankings, which are the StockCharts technical ranking. This is a percentile ranking system that we designed in-house a number of years ago. And we have different universes that we use. We're looking at the large cap ranking system right now, but you can look at ETFs or industry groups or whatever that you like. And I'd encourage you to dig more into the different listings. A great way to differentiate a universe from strongest to weakest. Tesla has been one of the strongest names in the Scooter rankings for the longest time. Let's start there. Julius was looking at it earlier, talking about a pennant pattern here at the end. And I think, to his point, to build on that, I think on a chart like Tesla, and it reminds me a lot of something like Plug Power, which has consistently been the strongest stock in our mid-cap ranking. It's down a pretty good bit today, down from a new closing high yesterday. But overall, you can see the consistency in these charts. On the daily chart, it's a fairly consistent pattern of higher highs and higher lows. And even when things start to get shaken out, when it feels like things are all of a sudden rotating much more negatively, it's always important to look left on the chart and see where the most recent swing low is. And as long as the price continues to make higher lows, by definition, it's in an uptrend, right? Higher highs, higher lows, the stock is going up. And so, the consistent theme with those two charts, Tesla and like Plug Power, is just the fact that they've been in consistent uptrends. I think the higher highs and higher lows are pretty clear. So with Tesla, you have some support around 800. That would be the lower end of that pennant pattern that Julius mentioned. This is from the first week in January. It holds above that. I think overall it's still obviously in very, very good shape. Something like this can pull back quite a way, 200 points down to get to its 50-day moving average, and that would still be a fairly decent appreciation over time. So think about some of those long-term trends. And overall, Tesla is now the third. What's interesting to me is it's been overtaken by two other names. This is NIO. It's a 74 billion market cap stock. You may not be familiar with. It's in the same group. It's in automobiles. If you look at this, you can see again a consistent uptrend. This was sort of chopping around and a non-factor back here the first 6 months of 2020, and then just look how it exploded to the upside. This is a single-digit stock that just continued to build and build and build, and this is when it gains market caps, when it becomes a large cap name, and all of a sudden gets on people's radar. What's interesting about this name, and I think this is what I would be, a bit concerned about, is the fact that you're seeing a couple things on a chart like this. Again, this is the number one ranked stock in our Scooter ranking. So I guarantee there are worse charts out there. There are charts that are already breaking down. This is still early on, and we haven't broken down through the most recent high, the most recent swing low. But what concerns me on a chart like this is the fact that you have a bearish divergence with RSI. So you have higher highs in price. You have lower peaks, successive lower peaks, higher highs in price, lower peaks in the RSI. That's a bearish divergence that speaks to some momentum weakness going into those new highs. We've now made a lower high in price. So we have not made a lower low yet, but we have made a lower high. In an uptrend, higher highs and higher lows, a downtrend, lower lows and lower highs. So we're pretty close, especially on a tactical time frame, on a shorter time frame, to indicate a rotation from appreciation to depreciation, or from accumulation to distribution, is how I normally would say it. Now, the reason why this scores so well is look at the relative strength and look at how well this is done versus other stocks out there. This is why it's one of the strongest charts, because it's up 1,000+% on a relative basis to the S&P 500. So obviously it's a decent move going from $5 to $50 some in 6 months. That's certainly going to get it a place of honor on the relative strength list. But it's worth noting in the short term, mentor of mine, Ned Davis, once said at a dinner we had, all large losses begin as small losses. So remember that when something's down a little bit, that could be the beginning of something deeper. Also worth noting, it about doubled the sell-off that the S&P had today. The second one is MAC. This is Macerich, and I'm Macerich. I'm totally butchering probably the pronunciation of that, but I'm not familiar with the stock. I am familiar with the fact that it's somehow bounced up to the top of our large cap rankings because it's grown so much so quickly. It's come up here. What concerns me about names like this, these are really going vertical. So it reminds me obviously a lot of GameStop and AMC and some of these other ones that are these squeeze names that are just going vertical for a lot of reasons other than the fundamental valuations of the stock. It's sort of going up. So it looks a lot like the Kroger chart and other things that have sort of increased the upside. So I'm skeptical about what I'm seeing, but I would say that again, as long as the trend remains in place, as long as you make higher highs and higher lows, you're in pretty good shape. What concerns me about a chart like this is to make a new swing low, you'd have to get down to 13, which is almost halving this chart, meaning, you'd have to have a 50% loss just to trigger the stop here. So on an accelerated move like this, two things that I would suggest you do. Number one, look at a shorter term time frame. Look at like an hourly chart to understand the shorter term dynamics and maybe get some, to get your stops in place if you're trading this more actively. If not, just think about how your risk versus reward, and think about the fact that it's appreciated like this in a portfolio means it's growing. It's becoming a bigger and bigger bet. And what happens a lot of times is not only can you stay in things too long, it starts selling off and it really hurts you. It's not just that you forgot to lock in your profits. It's also by the fact that it's grown so much, it's actually becoming a bigger and bigger weight in your portfolio. It's something, investment managers, money managers think of all the time. And I find individual investors don't think of enough. So remember, a huge position or a position that increases in price dramatically becomes a huge weight. So think about how much risk you're allocating to on one particular position. That's all the time we have. I'll finish off with my friend Price Headley. We interviewed him for Behind the Charts about a year ago, probably, I want to say. And he said, if you're not able to sleep at night, that tells you that your position sizing is too big. And I asked him how he thought about, when people get uncomfortable with, how they're placing their bets, and if they're not, they're nervous about the performance of their holdings. And he said that was it. If you're losing sleep on your holdings, your positions are too large. So think about that. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Let's get to it. Chart number one is Bitcoin. And I'm showing this just from a longer term point of view, and longer term on Bitcoin is like a couple days, I feel like, but here going back to the September low, that's the last real base that Bitcoin has made. And from there really accelerated, went parabolic up to 42,000. Now it's pulled back, and now it keeps bouncing off this 38.2% retracement level, which is just below 30,000. Also, what's happening now, and this is what happened today, is it hit the 50-day moving average for the first time since back here last October. So we are now at that point of that line in the sand, if you will. I think if it's able to hold this Fibonacci level, hold the 50-day moving average, you could argue this is a pullback within an uptrend, and it's the next leg higher. If we start failing here tomorrow into the weekend, I would be concerned about a further downside. And I think the objective would be 22,000, which would be a 61.8% retracement. That would be a huge change of character. We've already had a good amount of distribution here in a couple of weeks, but that would be a much deeper loss for a lot of people that have been speculating on extreme further moves from here. Chart number two in our 3 and 3 is the S&P 500 and breadth in the form of the percent of stocks above their 50-day moving average. I'm always paying attention when I see the index doing one thing and I see a breadth indicator doing something different. And while we're not seeing it in all the breadth indicators, cumulative advanced decline line still holding up okay. The percent of stocks above their 200-day, totally fine. But the percent of stocks above that 50-day, it's sort of our early warning system as individual names start to rotate lower. And the chart of, CSX is the example I keep showing. This is something that's broken down through its 50-day moving average, but not yet its 200-day. The more that happens, that's going to show some internal weakness on stocks. The final chart on our 3 and 3 is this one, semiconductors. We didn't talk a lot about them, but that group was down almost double the sell-off of the S&P, down almost 5%. This is a bellwether group coming out of an overbought condition. My bullish thesis overall relies on groups like semiconductors doing okay. I would be concerned about a group like this selling off further, breaking down through its 50-day moving average and so forth. I'd be very keen on whether the 50-day moving average holds, whether RSI 40 holds, because if you look back, you can see that's been support previously. Folks, that is our show. Special thank you to Julius de Kempenaer for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.